Hey everyone, how's it going? We just got the closing bell for Friday, October 4th. We had a little bit of a gap up this morning because we got some news that the dock worker strike was going to get delayed, or they're going back to work until January 15th while they continue to negotiate. And then we also got some good employment data this morning that sent the markets higher. But as we traded throughout the day, we had quite a bit of a bit of activity, a lot of volatility. So let's take a look and see how that all developed. When we look at the SPY, we can see that initially we did gap up and we stayed kind of sideways for the first half hour or so of the morning, but then we started to break down, and then we followed the same pattern that we've been following for the last 2 or 3 weeks, where we go down one way, then we go the other way, and in the end, all we really did was chop sideways. So you can see that from the open right here, we closed pretty close to the open, maybe tiny bit higher. And it was just a chop fest sideways for most of the day, although it was a pretty wide range of chop fest. And you can see that there is a lot of opportunities here to get into at extreme levels or to play from the VWAP to an extreme level. So volatility is definitely up in the markets. Let's take a look where we actually closed. We closed at 572.97. The gamma levels that we were eyeing from early morning was 572 or 560 to 565 on the downside. So we didn't reach 572 until the last half hour or so. Last half hour, yes, about the last half hour. And then we did continue to move upwards. So we ended up at 573. Not too bad, not too far off, obviously not pinned at the level we expected, but it did give us a good indication pretty early in the morning. So now that we have closed up here at 590 or 573, then it does look like we've bounced off of that EMA 20. So was this enough of a mean reversion to allow us to move a lot higher? Well, for now, at least we'll see what develops over the weekend and how we start out on Monday. But for now, that 580 level is still in play. And it doesn't seem like we can go much higher than 580 before we come back for at least another mean reversion or maybe even a pullback. So right now, if we look at this, if all I have to do is draw a line like this, and it really just looks like all we've done is chop sideways. So from here to here to here to here. So this is the last 2, 3 weeks, 3 weeks. All we've been doing ever since the FOMC cut rates, all we've been doing is chopping sideways. So are we super optimistic? Well, from a pure technical perspective, it does look like we are still on uptrend. So you wouldn't, no one could blame anyone for being bullish and saying, hey, we're going to go to new highs and all-time highs, and quarter 4 is going to be amazing, and everything is looking super good, and we're just going to go long this market. We're still in a bull market. And the argument for that is obviously very clear. You could say that, well, you drew this flat level right here, okay, and there's obviously an area of liquidity right here. And we have this wedge pattern that is more likely to break upwards than downwards. That is all true. However, the thing that I've been saying over the last few weeks is still true as well. We have more space to go down than we have to go up, although it's starting to equalize. It's not as extreme as it was before. So even if we move upwards, if all we do is get capped out at 580 and start pulling back, well, that's not a good reward risk ratio for shifting your portfolio to be full on bull. And at this point, we don't want to bet that we're going to go bearish just quite yet. So there's no reason for us to go full on bear as well. So we just need to stay a little level headed, not get too excited. Yes, there's a lot of things going on in this world. Yes, the ATR is moving upwards. The VIX is moving up and down, and maybe ATR is not moving upwards because we've been stuck in this range, but the ADR is probably moving upwards. Let's check on that. ADR. Oh, that's still ATR. So let me get the SPY and let's bring in the ADR. the average daily range, we can see that we've got this little bit of a creep up over the last few days. So that is volatility starting to creep in, come into the market. If I look at the VIX, we can see that VIX still closed at 19.09. That is, for the market moving up, how much did it move up? About 1%, 0.9%, and the VIX still being up at 19. That's not everything is rosy and beautiful and butterflies and honey. That is saying that, okay, there's a little bit of mismatch here. So what we really want to be careful of, what I want to see in the VIX is, do we do one of these? Do we do one of these? Do we see like we did right here? It just kind of popped up and came back down. Or does it become we pop up and we're extended for a little bit, like over here? Or do we have a giant spike? Because leading up to these giant spikes, you can see that volatility starts to go up and then we have a huge spike. It doesn't just spike. So all of these big spikes, there is a little bit of a lead up to it. A little bit of a lead up to it, except for COVID. That was mostly caught everyone by surprise. So there is generally a lead up to spikes. So do we get that spike or does it kind of fizzle back down? And we really need to see this come back down near that 15 range and preferably down into this 11, 12, 13 range that we were at before for this market to keep on resuming its upward trend. However, the election and the uncertainty around the US elections are probably not going to allow VIX to come down below 15. So we may just chop in this range at least until the elections are over and we know who our next president is going to be. So for now, we just want to make sure, or not make sure, we just want to observe and see if we get that spike in volatility. If we do, well, let's put it this way. As long as we chop between this 15 and 20 range, or let's go a little bit more fine view, this say 18 and 20, 21 range, 18 and 21, I'll call it. As long as we're chopping in between there, this market is not really going to go anywhere. The S&P is probably going to keep on chopping, just like I've been saying was the highest probability event over the last couple weeks, 2-3 weeks. We've been talking about how most likely we're going to chop sideways into the elections. That's still the most probable event. And as long as we see volatility stay inside this range, this 20 to 18 range, or sorry, 21 to 18 range, then that is probably going to that's going to be what happens. If we see a breakdown below 18 down to 15, then this market will flow higher. And if we see it break above 21, then there's probably going to be a panic and we'll see this start to pull back. We have a weekend coming up. We don't know what's going to happen over the weekend. There could be war escalations. There could be other disagreements that affect the economy. All sorts of things could happen. So this is a time point where you really don't want to take risks over the weekend. And I guess it's a little too late for me to say that because the trading session is already over. But just watch out. Just watch and see if anything starts to develop over the weekend, especially geopolitically, that might send us in a spike and start breaking us out of this sideways choppy range. But for now, that's the most likely scenario, the choppiness sideways. So the other thing that we talked about earlier in the last few days was the dollar. We really want to start looking at that dollar and look at what happened over the last 2 days, especially today, the huge move up in the dollar. So this is starting to be a little uncomfortable because as long as that dollar goes up, remember what I said yesterday, that things are going to get more expensive for manufacturing, for transportation, for operations, for shipments of goods back and forth. So that's going to start putting downward pressure on the overall economy. And eventually that's going to catch up and Well, it should actually goes the other way. Eventually, the market is going to wake up to that fact and start to anticipate that slowdown in the economy. So this elevated VIX that we just saw, plus the dollar moving upwards, that's making me a little cautious and starting to not make me bearish, but making me feel like that I need protection in case anything goes down. So I would start to consider that, start looking at my portfolios over the weekend and see where I can start putting in some hedges in case we start to see recession fears creep into this market and we start to see some bearishness come into the market. So this dollar is going to be very important. The other thing I said is that as long as dollar goes up, it's going to be hard for dollar denominated assets to continue moving up absent some other force. So, and $1 denominated asset is oil, but clearly oil has gone up. So why? Because there's another force. There is these concerns about the Middle East and interruptions, and what if Israel strikes oil fields, and then we have a interruption in the supply of oil and energy throughout the world. Well, that's now we are clearly above this trend line that we drew yesterday. We are at or above this MA 150, which isn't normally that significant of a level. But what's more important is that we're in this choppy period of this. Let me just draw the box here. Where's, here we go. So if we draw this, we're now entering this box. Oops. That represents a decent amount of liquidity inside of the oil markets. So if we get completely through this box, then I would start to get really concerned about the potential bearish turn in the markets and a recession. For now, we're just right in the box. It's not great or comfortable that we landed inside the box today. We'll see what next week brings us. But that's another thing that I'm going to be observing very carefully. So those three things, everything that we mentioned so far, the VIX, the rising dollar, the oil prices, all of these three things are one of the reasons why I say there's limited upside in the markets. Yes, they can go higher. How much further and how much longer? For now, in the short term, it looks like about 580 on the S&P 500 or the SPY. So, and that limit is there until at least till October 18th, probably all the way until elections. Remember, we're only about 4 or 5 weeks away from elections now. So there's not that much time between now and then, and most likely these markets are going to be undecided. And actually, one idea that just came to me is if it's going to be so undecided, there's a couple things that we can do. So we can do some sideways trading types of strategies like iron condors or butterflies, and then you would want to make sure that you close those or that you choose expirations that are before the election. And as you get closer to the election, then you could focus on straddles and strangles because you're expecting that there's probably going to be a big move after the election results, unless the market starts to anticipate and see that there's a clear candidate who's going to win, in which case the market will move sooner. And that is dangerous for your iron condors and such, that where you're counting on markets staying in a tight range. Or as long as you have your condors such that the ranges are very tight, you'd want to be very careful about that, because this market could, or sorry, not this market, but the market could decide that one candidate is clearly doing better than the other. Although so far, according to all the polls, that it's kind of close. So that is why we've got that choppiness inside of the market. If there was a clear winner or a clear candidate that was heavily favored, then we would see a lot more directionality in this market. But since we're chopping sideways, and since we have all of these outside other pressures that are operating in the market other than just the elections, then we want to be very careful. So we've got 3 good reasons so far why we want to be very careful and not just go full on bull, and definitely not yet full on bear, because that was, again, technically everything looks very good. That could change kind of quickly if we get a gap down because of some sort of geopolitical event. For example, like the picture changed very quickly after COVID. Everything was, we were near all-time highs, and then when COVID hit, and then suddenly we were in an immediate bear market and recession. So, but that's black swan event. So something we talked about a little bit earlier, or something that I mentioned a little bit earlier, was having a hedge in place. So you want to consider that. I've talked about hedging a portfolio many, many times in this YouTube channel over the last, I don't even know, maybe 2 years, 3 years. I don't even, although maybe the channel hasn't been around for 3 years, but for a long time. For a long time, we've been doing a lot of hedges. Maybe I will do another example of one in the upcoming days. But for now, I'm just going to let that. Actually, we just did one immediately before the FOMC announcement. So if you want to see an example, it's probably the 16th or 17th, maybe the 18th when we talked about that. So you can see an example. And actually the hedge that was talked about during that time is still good. It's still a good strategy, still a good hedge. And I have it in place. At least I'm pretty sure that's the one. We talked about an SMH and a XLP. I can't remember, XLU, something like that. We had two hedges in place in case something went way up and something went way down. And we were actually able to close both with a profit, if I remember correctly, or at least on the upside, we closed with profit. And on the downside, if we suffered anything, it was very, very minor. But it is a good idea to have a longer term one in place. I'll just show you a quick example that I have one in one of my portfolios rather than going in and showing you how to construct another one. If you want to see the construction of it, then again, go back to the September, should be 17th or 18th, maybe 16th videos. So over here, there's one over here, this XSP. You can see that I have this all the way out to January because we designed this to cover all of the upcoming rate cut decisions and the election as well. So we've got this very wide 520, 420 put in the XSP. XSP is mini S&P 500 index. And we can see where is 520. So this thing doesn't start making money unless we drop below 520, and it will continue to make money, more and more money, until we hit 420. So you can see that's a huge range, but what we're protecting against is a recession, basically. If this market gaps down and starts to go into recession, this is a true black swan event, although now it's becoming less and less black swan with the escalating conflict over in the Middle East. It's a little bit less of a black swan than black swan means out of nowhere, no one expected it, just like COVID. It just hit everyone by surprise. If something happens in the Middle East right now, it's not going to be super surprising. So if we come in and have a true black swan event, or the events that are happening that we're already aware of are so bad that they cause an extreme panic inside of this market, then we'll gap down, then we'll come and we'll break at some point between now and January. If we go into recession, that's when this spread starts to make some money. And so this was a very cheap way to put on some protection against, at the time, black swan events, now a little bit more likely events. So just be careful. I would go between what I went over yesterday and what I went over today. You could combine those two videos and just take a careful look at, because there's other risks in the market. We still have China. We still have for now, the dock worker strikes thing seems to be behind us, but that's just pushed back. It's not actually resolved. We have earnings coming up. So how well are we going to do in this current round of earnings? We got a good employment report, but how will all the other data fall in place? Because the Fed speakers have been contradicting themselves ever since the FOMC. They've been speaking a whole lot since the last rate cut decision, when Powell was saying everything is great, everything's rosy, everything, we're just preemptively doing this. We're just want to show our support for how wonderful everything is. And then everyone else, and including Powell, in their speeches subsequently, have been saying, oh, well, if we see the data better, if we see the labor market better than what we anticipated, why we were saying that everything was fine, is everything was good. Why were we anticipating and projecting that things might be worse? So why did we really get that 50 basis point cut? Again, I haven't completed it yet, but we do still need to look a little bit more carefully at what's going on in that banking industry and see why did we get a 50 basis point rate cut. And up until a few days ago in our FedWatch tool, we were expecting, wow, okay. This is I'm shocked because just 2 days ago, look at this, 1 week ago, we had a 53% chance of a 50 basis point cut. And then and then yesterday that was down to 32, a little bit more reason coming in. Now we have a 0% chance and even a 1.1 chance, 1% chance that we're going to increase the rate. So this market really turned around and really started to kind of freak out and say, "Oh my God, we're not going to keep on getting these rate cuts. Maybe everything is not as wonderful and beautiful as the Fed is saying, and maybe they did cut 50 basis points because they're not seeing great data or they're anticipating something not so awesome is going to happen in the future." So this was this was a surprise for me to see this just now, because I was still in my head still had these numbers right here. So let's take a look at bonds real fast, and then we'll end this video. TLT, you can see gapped down today. You see this ever since the FOMC meeting. This has just been going straight down. So we are having that reversion of the curve coupled with rising energy costs. This is starting to look a lot like recession. Recession is brewing. Again, we're not there yet. So we don't want to make any decisions based on that view unless we're taking very long-term decisions or we're hedging ourselves. Like I showed you just now, that particular hedge, it's all the way out until January, although that's only about 3 months from now. But so it's not super long-term, but it's longer term than we normally talk about. It's definitely not just a swing trade. So we want to start thinking about this as something that might happen after the election. But for now, our focus is on the election and anything that might happen geopolitically between now and the election. After the election, the entire picture will change. And then, unless we get a clear candidate before the election, then it will change at that time. But in any case, by the time we get to the election, the picture will be very different. And we'll have to reevaluate everything on a shorter term basis. But for now, this, from a 6-month to 2-year perspective, this is not looking great. So again, another reason to take a look at our S&P and just say the risk to the downside is a lot greater than the risk to the upside. Or in other words, the risk that my potential for falling is greater, or the distance and the amount of money that I could lose is much greater than if this market goes down than if I go in, if I buy a put, what is my danger? It's if we move upwards. So if I buy a call, what is my danger? It's if we move downwards. So what we're saying is that it's much more dangerous to be in that call right now than it is to be in that put right now. So we want to take that into consideration. But again, technically everything is still fine. Everything is still bullish, and we are approaching or making new highs. We're just chopping sideways over here. It's a consolidation. After consolidation, we have big moves. So when does the consolidation end? One possible endpoint is the election. It is, of course, possible for it to end before that, but election is a certainty. It will almost guaranteed choppiness would end by the election. Would it do it sooner? Yeah. If there's another geopolitical thing that knocks us out, or if the one candidate clearly starts to lead over the other candidate, then could get knocked out of this range before the election cycle as well. So geopolitical or something in the picture changes with our political candidates, then that could knock us out of this range before election, but at least up until the election, we expect to chop sideways. That's a extended period of consolidation. And then after a consolidation, we run. After consolidation, we run. After consolidation, we run. The longer the consolidation is, generally, the longer we run. Okay? Let's see if we can find another one. So this would be quite a large range consolidation and a very long run, a smaller consolidation and a baby run. So the longer we consolidate here, the longer or sharper we can expect that run to be afterwards. They were just saying that if we run to the upside, it is more limited and I have less danger in a put than I would have if we run to the downside and I was in a call. So just use that information to make your own decision on on the balance of your portfolio. But for me personally, it is neutral with a small leaning either bullish or bearish depending on your viewpoint. Do you believe short term that we're going to go up? Medium term we might go down? Then you could lean slightly bullish, but make sure that you're quick to take profits. Or you say, well, let's forgo that bullishness and just go for the medium term and go downwards, just count on a pullback. There's a lot of different ways that you would play this. Or you can say Kane is completely wrong. This market is going to go up. I'm just going to lean towards the call side. If you decide I'm completely wrong, though, don't go and just allocate your entire portfolio to the bull side. That's the point. The point is maintaining a neutral portfolio and then lean it in one direction or the other, depending on your viewpoint or how you see the reward risk ratios of your particular investments and positions and how you want to take advantage of those risk reward ratios. All right, so that went on a little bit longer. The last couple have been a little bit longer. There's more going on in this world right now than there has been for a little while. So have a wonderful weekend, everyone. There's a lot to think about over the last couple of days, over the last couple of videos. If you need to, repeat them and then start forming your own view and start allocating your portfolio accordingly, because there is a lot in this market, whether it goes up or down. This market is starting to exhibit that is moving more. It is moved just like, even though we didn't end up going anywhere, we traveled quite a bit on the way to get to nowhere. So this market is starting to exhibit all week, and some of last week I was talking about how this market is starting to exhibit that it wants to move. And at some point in time, it's going to stop going in circles. It's going to move in a direction. And so the potential for the market to start running is high, although it is markedly less before the elections. So I'm done repeating myself. Have a wonderful weekend, and I will see you all next week.